Hello, and welcome to the headline segment of Making Sense of Markets, Quarter 4, 2016. My name is Matthew Carvalho, Director of Investment Research at Loring Ward, and I'll be your host for this segment. If I told you at the start of 2016 that the United Kingdom would vote to leave the European Union, that U.S. stock markets would have their worst start to a year in history, and that a political outsider would win the White House, what would you have predicted market returns would be like? Well, it turns out that while there were many unpredictable events in 2016, after all, the Cubs did win the World Series. When it came to the full year investment returns, they weren't actually that far from historical averages. Predictions are tough, especially about the future. Now, that quote, commonly attributed to Yogi Berra, is as true for the financial markets as anywhere else, as evidenced by this Barron's cover in February 2016 asking if the rise of popularity of extreme candidates like Bernie Sanders or Donald Trump was killing the market. Yet, by the end of the year, their tune had changed. And the thinking now was that the Trump rally would push the Dow past 20,000 and that rally would continue into 2017. In fact, we see drastic changes in sentiment across the industry on an annual basis. Here we're looking at predictions and the actual S&P 500 performance for the year. If we look back again towards the start of the year, on January 4th, CNBC reported that the S&P 500 falls more than 20% as it finally succumbs to the incipient global recession. On January 7th, the Wall Street Journal notes that the Dow and S&P are off to their worst starts ever. And in a call that will echo for many years, on January 11th, the Royal Bank of Scotland warns their clients to sell everything. As we headed to the summer, June 24th, the worry at that time was that the Brexit may trigger a global recession. Now, heading into the election, major Wall Street analysts agreed that the S&P 500 would likely sell off if Donald Trump wins. Yet by December 15th, Business Insider was reporting that the Trump rally will continue into this year. Another annual story we see is that the current stock market rally has persisted for too long, with the phrase long in the tooth a favorite of Wall Street media. In truth, we don't know how long any stock market rally will last. They can be as short as a few months or last for over a decade. But if you listen to the headlines over the last 8 years, you may have been sitting on the sidelines for quite some time, as we see warnings about the current rally extending all the way back to 2009. This time of year, it's common to see prediction issues in financial magazines or websites about the best places to invest in the coming year. For an industry observer like myself, this is a great opportunity to hold those predictions accountable and see how investors following those recommendations would have fared. Of the 7 that we were able to track down here, you can see that there is a range of gains from 2.3% to 10.6%. Yet most of these focused on U.S. stocks, and when compared to a simple index of U.S. large cap securities, they all failed to grow as much as the overall market. Now, we should keep in mind that U.S. stocks are only one segment of a well-diversified portfolio, yet still, imagine the disappointment if you had been following the advice of these columns and ended up much worse than the overall market itself. Another area of market exposure that did very well in 2016 was the Dow Jones Industrial Average. Now, we should keep in mind there are some detriments about the Dow. It is simply 30 stocks in the U.S. It only recently added Apple a couple years ago and still doesn't include many other large companies that we think of these days, such as Amazon. But the Dow is one of the oldest indexes and until recently was the one most often quoted by news outlets. In 2016, it raced from a low of 15,450 to within a hair of 20,000. This chart shows the amount of time in trading days that the Dow took to reach new milestones. Sometimes those were reached quickly. For example, in 1997, it breached 7,000 and then hit 8,000 just a few months later. While other times it may take a while, such as hitting 14,000 before the financial crisis in 2007, but then taking 6 years to make it to the 15,000 level. However, on average, since hitting 1,000 initially, it's hit another 1,000 mark every 2.5 years. And today, that represents only about a 5% change in the price level of the index. But nearing 20,000 begs the question, should we be excited when markets reach all-time highs, or should we be fearful? Well, we've done some research on that topic. specifically by looking at the performance of the market in periods following all-time highs compared to all other time periods. And it turns out that the results aren't all that different. For example, 1 year later, markets that had just hit an all-time high continued to gain an additional 7.39% compared to 7.64% for all other time periods. Now, it's key to remember that this has simply been the US market that we've been speaking about. A well-diversified investor will have exposure to many other areas like international small companies, emerging market companies, real estate investment trusts, or short-term bonds, which may perform differently at different time periods. And it's that difference in the timing of returns that's especially helpful to the long-term performance of a portfolio. So now that we've reviewed some of the bad predictions we've seen recently and determined that we really can't time markets, are there any predictions that we should pay attention to? Well, I came across a list of 10 predictions that I thought was pretty worthwhile to share. And I'd like to run these down David Letterman style. So here are my top 10 list of predictions. Number 10. TV pundits will frequently and loudly debate short-term market direction. Number 9. A new book will say the rules no longer apply and that everything has changed. Number 8. Another new book will say that nothing has really changed and that the old rules still apply. Number 7. Some companies will prosper, others will falter, and these will change year to year. Number 6. Markets will go up some of the time and down some of the time. Number 5. Acres of newsprint will be devoted to the likely path of interest rates. Number 4. Acres more will speculate on China's growth outlook. Number 3. Some economies will strengthen, others will weaken, and these will change year to year. Number 2. Parts of your portfolio will do better than other parts, but we don't know which. And the number 1 prediction to pay attention to this year: there will be unexpected news, and some of this will move prices. Well, turns out that this list was actually in an article from the start of 2016. But as a long-term investor, I think these are the only predictions that you should pay attention to every year. So thank you for joining our Quarter 4 recap today. For additional commentary, please view the Making Sense of Markets portion of the Loring Ward channel on YouTube.